Have you ever seen those offers from businesses, pay early and save, where they give you a discount if you settle your bill quickly? It seems like just a nice little perk for you, the customer. But, well, for the business, actually logging that transaction accurately in their financial records, that's quite a fascinating accounting puzzle. Today, we're going to pull back the curtain a bit on how companies navigate this, specifically under the key international accounting standard, IFRS 15, which is basically the global rulebook for how businesses recognize revenue from their customer contracts. And our focus, those prompt payment discounts.
Exactly. And our mission for this deep dive is really to walk you through the detailed 5-step approach for recognizing revenue first. But then to reveal something maybe a little counterintuitive, how the expectation, just the thought of whether a customer will take a discount, fundamentally changes how revenue gets recorded right at the start. Think about that. A company's financial story isn't just about what did happen, but what they expect you, the customer, to do. It sort of shifts accounting from just looking backwards to trying to predict the future.
Right, like a crystal ball almost.
Yeah.
And all the insights for this discussion today come directly from a really helpful document, discounts.pdf. It breaks down these rules with some very clear examples, which we'll get into. Okay, so before we dive right into the discounts themselves, we probably need to understand the main framework, right? Like the foundation for how any company recognizes income under IFRS 15. That 5-step approach. Could you walk us through those steps quickly?
Absolutely. Yeah, it's a crucial foundation. So when an entity is recognizing revenue, they follow this sequence. It ensures accuracy and comparability. First, step 1, they identify the contract they actually have with their customer. Simple enough. Then, step 2, they pinpoint the specific promises within that contract. We call these performance obligations. Basically, what exactly are they delivering? Goods, services, both. Third, and this is key for us today, they determine the transaction price. How much do they expect to get paid?
Okay.
Fourth, they allocate that price to each of those performance obligations they identified in step 2. And finally, step 5, they actually recognize the revenue on their income statement when they're, as they satisfy those obligations. So when they deliver the goods or perform the service. And as I mentioned, step 3, determine the transaction price. That's precisely where these prompt payment discounts become really relevant because it dictates the amount of money a company truly expects to be entitled to. That's the heart of it.
Okay, that makes sense. So step 3 is our focus. That brings us right to these prompt payment discounts. They seem straightforward from the outside, don't they? Just an incentive. But you're saying for the accountants, it throws a bit of a curveball.
It does, yeah. From the customer's perspective, very simple. You pay early, you save money. These discounts, sometimes called settlement or cash discounts, are offered to credit customers, people who don't pay immediately, to encourage them to pay up quickly, usually within a set window, like 10 days, 14 days, something like that.
Right.
The complication, the accounting challenge arises because these discounts introduce what IFRS 15 calls variable consideration.
Variable consideration. Okay, what does that mean exactly?
It means the actual amount of cash the company will receive is uncertain, it's variable, at the point they make the sale, because it depends entirely on a future event, whether the customer chooses to pay within that discount window or not.
Ah, okay. So the final price isn't fixed at the start.
Precisely. And IFRS 15 has specific rules for handling this uncertainty. It requires companies to estimate the amount of variable consideration they expect to receive. And this estimate isn't just pulled out of thin air. It should be based on things like their past experience, their customary business practices with similar customers. The goal is always to recognize revenue at an amount that reflects what you genuinely expect to collect.
So it sounds like there's a pretty big element of estimation involved here, like predicting customer behavior. But is it just a sort of best guess? Or does IFRS 15 give more specific rules on how confident they need to be in that prediction?
That's a really good question. And yes, there's a specific threshold. It's not just any guess. IFRS 15 introduces the highly probable threshold. Basically, variable consideration like this discount is only included in the transaction price.
Yeah.
So only recognized as revenue up front, if and only to the extent that it's highly probable that including it won't lead to a significant revenue reversal later on.
A significant revenue reversal, meaning they don't want companies booking revenue that they might have to take back later if the customer does take the discount when they didn't expect them to.
Exactly that. It's a constraint. It means companies need to be pretty confident in their estimates of customer behavior. If they're not highly probable, they generally have to be more conservative and potentially wait until the uncertainty is resolved.
Wow, okay. So it really hinges on that expectation. Not just what happens later with the cash, but what they think will happen right from the start. This feels like a good point to bring in those examples. Let's make this really concrete for you listening. Imagine a company, let's call them Jayco. They sell goods, list price is $2,000 on credit. They offer a 3% prompt payment discount if the customer pays within 14 days, standard stuff. But here's the key part. Based on their past experience with this specific customer, Jayco fully expects them to pay within the 14 days and take that 3% discount. How do they record that sale initially?
Right, great example. So in this first scenario, because Jayco expects the discount to be taken, IFRS 15 says they should record the revenue net of that expected discount right away. So I looked at the $2,000 list price. The discount is 3%, which is $60. They subtract that $60 from the $2,000, leaving $1,940. That $1,940 is what they initially record as both the money they expect to receive the trade receivable and the actual revenue from the sale.
Okay, so the initial entry is debit trade receivables, $1,940, credit revenue, $1,940. They're booking the sale at the lower amount straight away.
Exactly. It's reflecting their expectation of the cash they'll ultimately collect.
So what happens if the customer does exactly what Jayco expected? They pay the $1,940 within the 14 days.
Then the accounting is really straightforward. Jayco receives the $1,940 in cash. So they debit cash, $1,940, and they credit the trade receivable, $1,940 to clear it off their books.
Simple, no surprises, expectation met.
Correct.
But what if, things don't go as planned? What if, unexpectedly, this customer doesn't take the discount? Maybe they just miss the deadline and pay the full $2,000 after the 14 days are up.
Okay. So now the reality differs from the initial expectation. Jayco receives the full $2,000 cash. They initially only recorded a receivable of $9,940. So first, they record the cash coming in, debit cash $2,000. Then they need to clear that original receivable. Credit trade receivables $1,940.
But that doesn't balance. There's an extra $60.
Exactly. That extra $60 represents the discount they initially accounted for, but which wasn't actually taken. Since they received more cash than the revenue they first recognized, they need to adjust the revenue upwards. So they make an additional credit to revenue for $60. The full entry is Dr. Cash, $2,000, CR trade receivables, $1,940, and CR revenue, $60.
Got it. So they correct the initial underestimate of revenue because the customer didn't take the discount they expected them to.
Precisely. It brings the accounting back in line with the actual economic substance of the transaction.
Okay, that makes sense for when they expect the discount to be taken. But what about the flip side? Let's take another Jayco example. Maybe they sell goods to a different customer. List price this time is, say, $8,000. Same terms. 3% discount if paid within 14 days. But this time, based on this customer's history, Jayco expects them to pay after the 14 days. They expect them not to take the discount. How does that initial recording look now?
All right, scenario 2. Here, the expectation is different. Jayco expects the discount not to be taken. Therefore, they initially record the revenue at the full list price, the gross amount. So they record debit trade receivables $8,000 and credit revenue $8,000 right at the point of sale.
Because they're highly probable they'll get the full amount based on past behavior.
That's the logic, yes. They expect to be entitled to the full $8,000.
Okay. And if this customer then behaves exactly as expected, paying the full $8,000, but after the 14-day window has closed.
Then, just like in the first scenario when the expectation was met, the accounting is simple. Jayco receives the cash, debit cash, $8,000, and they clear the receivable. Credit trade receivables, $8,000. Done. No adjustments needed.
Straightforward again. But now for the unexpected twist in this scenario. What if, against Jayco's expectations, this customer does pay within the 14 days? They pay early and take the 3% discount. So Jayco only receives 97% of $8,000. That's $7,760. They expected $8,000, but only got $7,760.
Right. Now, reality is less than the expectation reflected in the initial accounting. This triggers that revenue reversal we talked about earlier. Jayco received $7,760 in cash. So debit cash, $7,760. They need to clear the full receivable they initially booked, which was $8,000. So credit trade receivables, $8,000.
Okay, again, that doesn't balance. They're short $240 on the debit side.
And that $240 difference is the discount the customer took unexpectedly. Since Jayco initially recorded the full $8,000 as revenue, but ultimately didn't get that much, they need to reduce the revenue they originally recognized. So they make a debit entry to revenue for $240.
So it reduces the sales figure they first reported.
Exactly. The full entry is Dr. Cash, $7,760, doctor revenue $240, and CR trade receivables $8,000. It correctly reflects that less revenue was ultimately earned than initially anticipated.
Wow. So it really does boil down to quite significant judgment on the company's part, estimating that likelihood.
It absolutely is.
Yep.
Significant judgment is required. It's not just a mechanical calculation. Entities really need to analyze past customer behavior, consider any changes in circumstances, really think about that highly probable threshold.
So this raises a question then. Why does all this matter beyond just, getting the debits and credits right? Does this judgment call actually impact their reported profits in a noticeable way?
Oh, definitely. That's a crucial point. These judgments, these estimates about whether discounts will be taken, they directly impact a company's reported gross profit margins. Think about it. Revenue is the top line. If your revenue recognition is fluctuating based on these estimates, and maybe your estimates aren't always spot on.
Then your reported profitability changes too.
Precisely. If a company consistently overestimates revenue because they assume that discounts won't be taken, but they often are, their margins might look inflated initially, only to be corrected later,
Right.
or vice versa. So it's really important for companies to have appropriate evidence, solid data to back up the judgments they make about these customer payment habits. Auditors will certainly look at this area.
Yeah, I can imagine. So this deep dive has really, it's shown us how IFRS 15 isn't just about recording history. It forces businesses to be forward-looking, to make these estimates about revenue, especially when you have things like prompt payment discounts, making the final amount uncertain. It's really about predicting customer behavior and building that prediction into the financial reporting right from the start.
That's a great summary. And what's fascinating, I think, is how these seemingly small decisions, these expectations about discounts, can ripple through and have a direct, visible impact on a company's reported profitability. It's a powerful illustration of how accounting isn't just about tallying up the past. It's also about making informed predictions about the future based on the best available information.
So maybe a final thought for you listening. Next time you see one of those prompt payment discounts offered to you, maybe pause for a second. Consider how that company, behind the scenes, might have had to estimate your likelihood of taking that discount and how that estimate affected the revenue they recognized when they first made the sale to you. It really makes you think about how crucial good data on past customer habits is for businesses trying to make these kinds of financial predictions accurately. It's not just numbers, it's about understanding behavior.